Last time I spoke to you was actually in the Beaver Creek conference a while back.
Right.
Lots has changed in terms of geopolitics around the world. Not a lot has changed for the gold price. We have seen a nice rally in the gold price in the beginning of the year, but more significantly, I'm seeing a rally in the GDXJ, the Junior Gold Miners Index. So we'll talk about that in just a minute. But let's set the stage, so to speak, for the investment landscape of gold. Inflation's gone up, as you know, 7.5% headline CPI is the highest in 40 years. Some economists I've spoken to are projecting even higher levels of inflation going forward. What does this mean for gold?
So I think the key thing for me was when Powell kind of admitted this, right, from the Fed in November. He basically said publicly, like, we admit that we got this wrong. And we've been talking about this, David, on your show since the summer of last year, that CPI was going to get, higher and stay higher. And, we took a different approach, I guess, to that. And we've been fully invested through most of the difficult part of 2021 as a result, because we thought that that's going to eventually, raise gold and silver prices and therefore raise the mining prices, right? And so now I think it's on everyone's mind. If you go to a hotel, if you rent a rental car, if you go and buy just generic stuff like, beef or get your gas tank filled. I mean, this is really impacting not only the U.S. investor, but the global investor. So it's a real problem. And so I think, go ahead, David.
No, you go ahead.
So I feel that, CPI is definitely going to rage higher for a while, and it's going to be a persistent problem. We'll see if that's true on March 10th when the next read comes. But there's no question in my mind that the Fed is going to raise regardless of what that number is on March 16th. It's just, if we were to have this interview just a few weeks earlier, we were looking at a 65% probability of a 50 basis point rate hike from the Fed. And now that is completely out the window.
Exactly. So now, yeah, exactly. So it's, I was looking at the Fed Watch tool from the CMA the other day, 50 basis point to 75 basis point. I believe that probability for that bracket is like 2.7 or something very low. So
right.
let's assume the market's right and we can rule that out. But let's talk about what inflation is going to do. So you mentioned that inflation is not going to have a direct impact on the Fed anyway, because like you said, if inflation doesn't go up, in either case, the Fed has to raise rates by at least 25 basis points. Is that what you're saying?
What I'm saying is, as we were to have this, again, a few weeks ago, that the consensus amongst big banks in the U.S. was 4 rate hikes, maybe 5, depending on who you were reading, right? No one was at 2. No one was at 3. We're talking like Bank of America, Wells Fargo, the big names. So when I look at today's situation, right, with all that's happened with the momentum stock selling off and having this Russian tension, how are you going to raise rates 4 or 5 times in this environment right now? I think in hearing Powell testify this week, he was very guarded, much more guarded than he was in January or even February. So I think the Fed is realizing that this situation in Russia is fluid, and they have to just watch what's happening and make assessments accordingly.
Okay. Well, regardless of what the Fed does, one of the more important indicators, or the drivers of the gold price, rather, is the real interest rate. So let's take a look at what the real interest rate has been doing over the past year or so. It's been in negative territory, and analysts I've spoken to have said that, again, regardless of what the Fed does, it's not enough to raise a real interest rate back into positive territory. So negative real interest rates should be good for gold, they argue. Now, here's my counter argument, and I'd like you to respond to this, John. Yes, you're right. I mean, everyone's right in the sense that negative real interest rates are good for gold, but look at where real interest rates have been in the last year and a half. They've been negative, but they've been flat. And so the gold price has also been flat. I would argue that it's more the direction of the real interest rate that matters more than the absolute level. So even if we stay flat and negative territory, that still doesn't mean gold's going to go anywhere. How would you respond?
As an equity person in this sector, I'm less concerned about the gold price than your average guest, right? I still think that, when we looked at the situation when we last met, David, in the fall, right? We were at 1750 to 1850 gold per ounce all day long for months. And we were of the belief that we would break the 1850 to the upside, which we have. But even so, like, you're just seeing this reaction, a positive reaction from the mining complex now that we've broken 1850 and now 1900 and now 1950, right? So we're taking out these major resistance levels, but we're doing it in a methodic way, which I like. We're not seeing gold go up 3%, 4% in a day, right? Which I wouldn't want to see. I like this gradual move higher towards the key $2,000, round number. But I do believe that, we're going to retest the summer of 2020 highs in the gold price, which means that's why, to your point at the onset, you want to have leverage to that. And that's why we own no gold right now. We own gold stocks hand over fist.
Well, let's talk about the gold stocks. I know you are an investor in primarily juniors, but I want to touch on the seniors first and how they've been performing. Now, a lot of people have told me that $1,800, $1,900, which is what we've been seeing for a while. Yes, it's not really the all-time highs like we saw 2 years ago, but $1,800 is still very good for equities, they argue. They argue that at $1,800, the miners, the seniors are making very good cash flow. Well, I'm not so sure about that because I'm taking a look at Barrick, for example, just as a proxy. I'm not talking about all miners, just one of the bigger ones. Barrick, in 2020, their free cash flow was $3.3 billion. In 2021, that dropped to $1.9 billion of free cash flow. That's a 42% decrease year over year. Now, their stock has also reflected that. They haven't done very well over 2021. Now, I'm just saying that, yes, they're $1,800. Their top line revenue hasn't really decreased. It's just their costs have gone up. Their all-in sustaining cost, for example, went from $967 an ounce to over 1,000. So $10.26 an ounce was their latest all-in sustaining costs. So their margins are starting to feel the pressure from inflation, higher energy costs, and all that. So I'm just arguing, John, like all these analysts saying that $1,800 has been good for the equities, they haven't really taken into account inflation eating away at the margins, right?
That's true. And if you've looked at some of the juniors that have launched what we call a PFS study recently here, they've shown a higher CapEx in their report because the input costs have gone up dramatically, right, in the commodities complex. So that to me is worrisome. As you pointed out, probably margins are being hit a little bit here because energy keeps raging higher. And if you're a producer, you need energy, right, to run the rigs. So there are some concerns like that out there to me, but I think the broader theme should be that, I worked in the mutual fund and ETF business all of my life before starting my company. And large cap value manager mentality is give me something cheap that pays a reasonable dividend. That is like Newmont all the way, right? Like it's a stock we don't own other than through our exposure in GDX right now. But if you look at that chart, December 15th on the Fed day, it was at $51. It hasn't looked back. It crossed $74 today on high volume, and it's yielding, 3.2%. So it's very attractive to the mutual fund and ETF community, I think. And you're going to start seeing more people buy the beaten up names, like you said, like Barrick, right? At $10.26 an ounce, if you're at 1,900, you're still making whatever that is, $874 an ounce, like a margin. It's insane.
Okay. Well, look, the margins are good, but when can we start seeing that being reflected in the share price, you think?
Yeah, that obviously people are waited a long time for that, right? And so what let me just give a disclaimer that Barrick has done very well year to date. I think they're up like 20% since the beginning of the year. So I'm not saying they've been, an underperformer at all. I mean, over the last year, yes, everyone's stocks have gone down, but people are starting to see a bit of a rebound. But yes, continue. Yeah, so I think people have been very patient in our sector. There's been a lot of people that couldn't handle the volatility. We always talk about, understand what your personal risk is, and how that, is reflected in your goals and dreams. It's like you can't just buy stocks and cross your fingers. That's not a strategy. So, with the large cap space, it's a good place for the average investor to start. And you can do that through buying something like GDX because it holds a lot of the names we just talked about, right? It has big positions in Newmont, Barrick,